Welcome to ZaranTech, your ultimate destination for end-to-end SAP training. If you are an SAP aspirant looking to excel in S4HANA interviews, this exclusive video is for you. Today, we will be exploring the top 30 SAP S4HANA Central Finance interview questions and answers. Whether you are an experienced SAP expert or just started, these videos provide detailed explanations for the most common central finance questions asked. We will dive deep into the world of central finance with SAP S4HANA. We will unravel key concepts around central finance architecture, virtual close processes, and integration techniques. We will equip you with in-depth understanding and the ability to tackle any related questions comfortably. By the end of this training video, you will be mastered central finance module, replication methods, data virtualization, as well as reasoning behind adoption for an interview preparation perspective. The structured and comprehensive responses will arm you with practical knowledge to stand apart in your next S4HANA role. So get ready to explore the top interview questions in the central finance in SAP S4HANA. Let's dive into the fundamental questions in the realm of SAP. What is SAP Simple Finance? SAP Simple Finance is a next generation finance solution natively built on SAP HANA and offered as a part of SAP S4HANA financial capability. It transforms and dramatically simplifies financial processes for greater efficiency and speed through real-time operations. What are posting periods? Posting periods are time intervals that control when accounting documents can be posted and processed in the system. The posting period variant is setting the govern which posting periods are open or closed from company code at any point. Since closing operations happens periodically, company often use month-end or year-end periods. Some aspects of posting periods. The variant can be defined normal periods like months or years plus any special period. Period status control whether documents can be posted into them or closed for posting. Different company codes can have independent posting period variant and statuses based on the closing cycle. Posting periods are defined in independent or fiscal year variant in the system. In a sense, posting period variant with different interval types allows financial controllers to implement control around when the documents can hit the book to enable key closure activities in SAP. What is capacity requirement planning? Capacity requirement planning or CRP refers to process for accurately determining the machine and manual labor resources needed to refill a specific production plan or manufacturing schedule. It calculates detailed capacity level like man hour, man runtime required, taking into account production cost, product BOMs, routing steps, available capacities of work centers while considering any planned showdowns as well. The goal of CRP is to ensure the shop floor and workforce availability is adequately provisioned, timed, and sequenced to meet the production targets committed. Any constraints get highlighted well in advance. The output of this planning run are actionable plans to develop capacities through means like hiring, training, subcontracting based on spikes predicted across the planning horizon. Plans also provide realistic production targets achievable given capacity restriction. In a sense, CRP matches net requirement with available capacities all the way down to work centers level enables realistic and feasible production plans. What are document types and what are their purpose? Document types are unique identifiers used to characterize different class of business transaction that get posted in financial accounting in SAP. Some common financial document types also include SA for general ledger, general entries, KR for vendor invoices, and DR for customer billing. The document type controls important aspects like permitting accounts that can be posted to authorized users, assign number ranges, currency settings, and even mandatory field required in the header while entering transactions. By denoting distinct types of accounting documents, they enable automated checks and streamlined processes tailored to the transaction flow. Document types also integrate with workflow, approval, count determination logic, and reporting classification. In a sense, they provide the flexibility to model various real world financial processes through custom attributes, processes, rules specific to the document category. So that explains that document types represents in SAP and why their vital components enable targeted finance. How are tolerance group used for employees? Tolerance groups contains financial posting amounts, limits and ranges that determines maximum value employees can enter for transaction. Different tolerance group can be defined with amount threshold based on roles. For instance, an accountant may have higher document total limits than a clerk. These tolerance group then get assigned to user IDs in SAPs. This enforces posting restrictions so that the personnel can only make entries up to certain amount as per their access level. It ensures proper segregation of duties with larger transaction requiring approval from senior management. In a sense, the tolerance group streamlines the authorization management process for financial posting by centrally storing value limits mapped across to relevant employee or roles. This saves effort compared to maintaining multiple individual users' access levels to enforce payment caps or approval triggers. So, in summary, that's how tolerance group help govern posting amounts for authorized SAP users. What drives customer migration to SAP S4HANA? There are six compelling reasons drawing clients to S4HANA. Number one, delivers simplicity and instant value across business functions through sophisticated capabilities. Number two, redefines enterprise software value by serving a digital transformation platform. Number three, designed for simplicity, allowing users to tap into superior innovation. Number four, open platform on SAP HANA Cloud Edition, enabling next gen application. Number five, power intelligent recommendation and stimulation using machine learning capabilities. Number six, protects existing investments while delivering latest innovation. In a sense, S4HANA fulfills the main vision of SAP to help customers thrive easily in the digital world. It does this by simplifying processes, opening up to innovation potential and delivering intelligence, all while securing legacy configuration customized over the years. This unique value proposition is accelerating enterprise adoption and migration to S4HANA in recent years. Let's examine a common question around supply chain concepts. What is the difference between logistic and transportation? Logistic refers to the overall process of managing the flow of goods, resources, and information from raw material sources through production to the final consumer. It covers activities across procurement, manufacturing, distribution to deliver value. Transportation focuses especially on the movement of physical products from one location to another. It deals with the actual shipment mode, routes, carriers, and vehicles used to physically displays inventory or cargo, while transportation handles the physical flow. Logistic looks at optimizing process flows more holistically across sourcing, production, and delivery to meet business needs and customer demands. So, in summary, logistic views end-to-end flow of materials and information across the supply chain, while transportation is a subset focusing on actual transfer of goods from point A to point B. Let's explore a key aspect of SAP HANA database and how is SQL statement executed. In SAP HANA database, every SQL query statement gets executed within a transactional context uniquely identified by its transaction ID. This transaction ID tracks the entire life cycle of the statement from initiation process through processing to commit or rollback. When a SQL statement like select or update is issued, the SQL script search engine initializes a new season, allocating separate memory and log buffers for statement execution. All logs, resources, usage, intermediate results, and logging happens isolated within the session corresponding to the transaction ID. One processing finishes and the session commits working memory changes into this restore to persist results. Change data gates visible to the other transaction only after the commit. In essence, SAP HANA leverages transactional integrity, isolation memory, and centralized logging to enable robust and performant execution of SQL script statements. This transactional architecture allows HANA to process high level of SQL queries in parallel without collision across data or processes. Let's examine the key warehouse management concept. What is wave picking? Wave picking refers to the batching technique where multiple customer orders getting fulfilled from the warehouse are logistically grouped into waves. Instead of releasing order individually, waves consolidate orders with commonalities like delivery date, route, products, areas, and other attributes. These order batches or waves then get released together for fulfillment activities. All picking tasks, labeling, staging happens at the wave level in parallel. Wave picking enables efficient batching of order, which allows timed release of batches balancing workload, group orders with common fulfillment needs, enables multiple orders to get processed in parallel, reduces consumption, by streamlining material flow. In essence, wave picking introduces a batching logic across orders to maximize efficiency of warehouse tasks through workload balancing, batch standardization, and resources optimization. So, that's what wave picking aims to achieve as an important warehouse optimization concept. Let's explore a term often used in quality inspection. What is the meaning of triage? Triage refers to the sorting, characterization, and prioritization of items based on certain attributes, specifically the quality or condition of goods in the business context. In inventory management, triage involves assessing received vendor shipments in process material or finished stocks to determine the state of items. Based on triage, items are classified as comforting and ready to use, needing rework before acceptance, and even being unsalvageable write offs. Defective parts may be sold off as scraps and attracts warranty claims. So, in essence, Triage enables a structured inspection, sorting, and upstreaming action taking on goods belonging to various quality buckets depending on their common conformance to expected standards. By quickly segregating problematic stocks, companies can save costs through timely root cause analysis or fast track scrap liquidation. So that explains the purpose and meaning of triage in material management. Let's examine a common question around S4HANA Deployment. Which edition is best suited for customer landscapes? The SAP S4HANA on-premise edition provides more extensive capabilities, allowing wider integration and customization for complex requirements. Whereas SAP S4HANA Cloud Edition offers standardized processes for basic scenarios with faster pace of innovation. Key differences: on-premise edition, board and deep integrated functionality, high flexible personalization, suits organization running, heavy customization. Cloud edition, standardized for basic business scenarios, rapid innovation cycles, better for targeted industry solution. A hybrid model is possible, combining both editions where required functionalities reside on premise while innovation agility levels the cloud. In summary, on premise edition allows more customization. Cloud focuses on standardized processes and faster innovation. So, the best S4 HANA edition depends on the organizational functional breadth, changes dynamics, and business priorities. Let's explore an important concept in financial accounting. What are adjustment posting and how are they used? Adjustment posting refers to correcting or modifying accounting documentation that has already been recorded and posted in financial book. Typical adjustment scenario include rebate settlements, intercompany charge transfer, inventory count varies, and revaluation of asset book values. In SAP, adjustment posting leverages special GL transaction types like FB50 along with reversal reason codes. This ensures the auditability while preserving earlier document flows. They enable backdated amendments to key master attributes or booked total without having to redo the entire document sequences. Adjustments also integrate with month end closing. Common business needs for adjustment posting are to reflect rebates for incentives for vendors, transfer internal cost, and charges accounts for inventory differences or fluctuation in currency or material prices. In essence, adjustment provides the flexibility to handle exceptions or changes to already posting accounting data while maintaining system integrity. Demystify an important aspect of financial document. What are posting keys? Posting keys are a central role in classifying accounting documents and entries in SAP. They indicate whether a transaction is a debit or credit along with permitted field status combination. Posting keys have predefined configurations delivered by SAP for standard document types like customer invoices, vendor bills, etc. These contains debit credit assumption and mandatory field makers. To modify behavior of a standard posting key like making certain field optional, best practice is to create a copy of SAP provided posting key. Apply changes to copy without altering original template. This avoids directly updating standard delivered by SAP. So, in essence, posting keys determine the debit credit orientation and field requirement within financial entries. Custom versions can meet reporting needs while retaining standards SAP configuration. That summarizes the vital concept of posting keys in SAP. Let's explore an interesting scenario. Can a company exhibit positive cash flow yet undergo financial difficulties? The answer is yes. Here are two examples of how paradoxical situation can emerge. First, a company liquidating inventory and delaying vendor payments can temporarily show positive operating cash flow. However, diminishing assets on the balance sheet and unmanaged liabilities signal future insolvency risk. Second, a growth company might currently have strong revenue but forecasts predict decline sales due to lack of new prospects or customer in the pipeline. While near-term cash position seems healthy, upcoming downwards correction can cause trouble. In essence, cash flow are trailing indicators while financial statements and projections provide more insights into future viability. Relying solely on positive cash flow without assessing the finance complete picture across all statements, ratios, forecasts can give false comfort until issue surface. So indeed, companies can report positive cash while facing encroaching financial troubles. Evaluating the complete set of statements and projection is vital. Let's examine an important concept in SAP invoice processing. What do net posting refers to? Net posting allows recording just the net invoice amount exclusive of any taxes and deduction. This is useful where tax calculation happens outside the system. Net postings are relevant for both vendors and customer invoices using documents type KN and DN respectively, where KN and DN post only the net value without additional tax amounts on early payment discounts. This is unlike standard document types like KR and DR, which posts across invoice amounts. To enable net posting, the configuration setting to activate the functionality needs to be turned on. So, in summary, the special net posting document types allows isolating and recording only the net amount on invoices, skipping additional taxes or deduction. This requires customization changes to activate the capability for company code reporting needs. That explains the concept of net posting for streamlined invoice processing in SAP. Let's analyze an interesting aspect in accounting. How does purchase of a fixed asset impact key financial statement? When an asset gets purchased, there is an immediate cash outflow reducing the cash balances on the balance sheet. The capitalized value of the asset also gets added to property, plants and equipment balances on the same balance sheet. Over the useful life of the asset, regular depreciation impacts the income statement, reducing net profit figure. It also proportionately brings down the asset value on the balance sheet with the offset hitting retained earning reserves. However, since depreciation is a non cash accounting charge, it gets added back to determine cash flow for operating on the statement of cash flow. In summary, the asset purchase entry impacts the balance sheet first, reducing the cash and creating the asset. The income statement shows the depreciation cost later, while the cash flow addition recaptures this non cash deduction. So, an integrated view is essential across three key statements to assess true financial health of an expertise over time. Let's analyze the interesting aspect in accounting. How does asset purchase impacts key financial statement? When an asset is purchased, there is an immediate cash outflow reducing the cash balances on the balance sheet. The capitalized value of the cash asset also gets added to property, plant, and equipment balances on the same balance sheet. Over the useful life of the asset, the regular depreciation impacts the income statement, reducing net profit figure. It also proportionately brings down the asset value on the balance sheet with offset hitting retained earning reserves. However, since depreciation is a non cash accounting charge, it gets added back to determine the cash flow from operations on the statement of the cash flow. In summary, the asset purchase entry impacts the balance sheet first, reducing cash, creating the asset. Income statement shows the depreciation cost later, while cash flow addition recaptures this non cash deduction. So, an integrated view is essential across three statements to assess true financial health of an enterprise over time. Let's explore a key concept related to general ledger integration. What are the field status group in SAP? Field status groups determines the additional dimension and other fields that can be posted in the line item level in the general ledger document. They contains flag marking data elements like cost centers, profit centers, functional areas, optional, mandatory, surpassed, and requiree entry field per GL account. Configuring field status variant by GL account ensures transaction can capture all data's attributes needed to subsequent reporting or relocation needs as relevant. Default items or default field status group delivers by SAP have common settings, but custom variant helps model accounts posting as per business needs across management, profitability, and statutory reporting while aiding audit compliance. In essence, the field status group controls the presence optionally and validity of additional field during the item line, data capture, and general ledger document that summarizes the concept of field status in controlling integration to GL. Let's understand an important supply chain concept. What are chargebacks? Chargebacks refers to penalties or fee imposed on suppliers by buyers when goods or invoices received did not adhere or previously agreed terms and conditions. For example, a chargeback may apply if the packaging specifically was not followed or the products were incorrectly labeled or shipped, resulting in the process of inefficiencies for the customer. A chargeback claims essentially allows the buyer to recover parts of the cost incurred to resolve non-compliant shipment like rework, delays, and even charge the vendor for customer dissatisfaction. Common business contexts where chargebacks occur, including excess transportation fees, incomplete or missing documents, failures to meet quality standards, incorrect product specification, or even late deliveries requiring expedited handling. In essence, chargeback enables buyer to penalize sellers for contractual non-compliance to recover resulting financial impact or act as a deterrent for consistent violation. Let's examine a key supply chain metric. What is the cycle time? A cycle time refers to the total time elapsed between two defined points in a business process flow. In order fulfillment context, it specifically measures the duration taken from the moment of customer order gets logged in SAP till the final shipment leaves the warehouse dock. It aggregates the time consumed across order entry, picking, packing, staging for dispatch to represent end to end speed for process and fulfill demands. Driving down this cycle through the workflow improvement, bottleneck elimination, and cross functional coordination enhances business performance through faster customer response. Reduced cycle time helps meet the service level agreements, lower lead times, cut work in process, and improves on delay delivery to aid customer satisfaction. Tracking cycle time evolution also helps benchmark shop floor warehouse efficiencies for identifying problem areas that explains. Let's examine a common term in global trade. What are bounded warehouses? Bounded warehouses refers to secure facilities where imported goods can be stored typically for up to a year without payment of application customer duties or taxes until they are taken out of the final consumption. They provide intermediary location, allowing traders to hold shipment after customs clearing but prior to the duty payment, depending on downstream supply chain flow. Once good departs the warehouse and enter domestic channels or get exported externally again, applicable taxes and duties apply accordingly. So, bonded facilities essentially offers temporary suspension of tax and duty liabilities, allowing cost optimization in trader supply operation. The warehousing infrastructure and control protocol have to meet custom compliance standards through appropriate bond and guarantees in order to operate such duty deferred inventory holding areas. That explains the purpose and operation of bonded warehouse for global shipments. Let's explore a key element of document processing and what is a document header. A document header consists or contains information applicable to the entire posted business transaction as opposed to line items detail. Typical fields sorted as per the part of documents header are: number one, document date denoting when the transaction got initiated. Number two, document type indicating the category like invoices or payments. Number three, system assigned document number for unique identification. Number four, posting date when the entry was recorded on the book. 5. Posting period denoting the interval if the falls under. Number 6. Company code representing the business unit. Additionally, it may store creator details, custom text, approval status, and links to connected documents. Document headers enables quickly analyzing common attributes across multiple transactions for reporting needs without drilling into the detailed body. So, in summary, the document header stores metadata for complete business document that requires or remains consistent across the different posting rows. Let's explore how account types link to the document types in SAP Financial Posting. Document types like invoice date, credit memos, asset retirements are denoted by two character codes like KR, DR, AA, respect. Whereas account types use a one character code to represent the category like the balance sheet accounts, customers, vendors, etc. For example, A for asset, D for customer, K for vendors. The integration logic allows specifying which account type was valid for posting with a given document type code. For instance, the vendor invoices KR may allow posting to K type vendors accounts and S type general ledger account, while asset sale A may permit a key type asset only. This account type controls for allowed documents type processing accuracy, financial compliance, and auditability or downstream reporting. In summary, integration between account types and document types ensure transaction gets recorded with appropriate accounts category based on real world businesses event flows mapped in SAP. Let's examine a common question around S4HANA transaction and what is the main difference between migrating to SAP S4HANA on-premise versus the Cloud Finance Cloud Edition. For finance perspective, there is no significant difference between the two migration approaches in S4HANA. Both follow similar technique steps for data transitions focused on financial close reporting and processing. However, they considering SAP S4HANA on-premise, additional implications beyond finance have been analyzed due to integration with logistics processes like inventory, manufacturing, and supply chain. Here, aspects like material number changes, production integration, and master data mapping requires to ensure holistic alignment for order to cash and procure to pay processes. Whereas the Finance Cloud Edition scope is generally contained to core financial capabilities, allowing faster transaction focused exclusively on ledger planning and closing activities. In summary, the migration steps of finance also aligned across both editions, but S4HANA on premise undergoes larger business processes transition encompassing logistics. The Finance Cloud Edition offers more isolated financial migrations. Let's explore an important question: how SAP Partner assist with customer transaction over SAP S4HANA. SAP possesses a vast ecosystem of capable partners, including large system indicators, niche boutique firms, and value added resellers. Many of these already actively support over 50% of existing SAP Business Suite and HANA installed across customer landscapes. Leveraging the solid experience, partners offer services like technical upgrades, migration planning, functional transaction, post transformation support for adopting SAP S4HANA and its simple finance solution. Their expertise helps to accelerate time to value by streamlining deployment, safeguarding cutovers, activities, and transferring customer teams onto the new S4 platform. Partners also deliver premium and enablement, customs development, and niche outcomes based offering that maximize ROI across transformation initiative. In essence, SAP partners play a pivotal role in guiding and supporting customers to confidently transition core business operations into SAP S4HANA for faster returns on investment. Let's explore an interesting question that often comes up. We transform an existing balance sheet general ledger account into profit and loss account in SAP. Technically, it is possible to modify all attributes of a configured general ledger account, including the account type categorization from balance sheet to profit and loss. This can be changed in a chart of accounts maintenance transaction, however, after altering the account type. It is strongly recommended to re-execute the balance carry-on forward program. This will transfer closing balances and old fiscal year and post appropriate offsetting entries mapped to the revised account type. This adjustment ensures the integrity of brought forward balances into a new fiscal year by aligning historical total to the new account classification and accounting treatment per reporting standard. And in summary, the changing GL account type is achievable through configuration but requires balanced carryover adjustment for accurate financial closure. Let's explore a common concept in finance. How do we calculate the weighted average cost of a capital or WACC? WACC determines the blended rate of return required across a company's different funding resources appropriately or proportionately. This includes both debit and equity capital. The formula follows a weighted structure. Percentage of debt in the total capital mix is taken. This is multiplied by the cost of debt, that is prevailing interest rates on borrowed capitals, and this product is then adjusted for many tax benefits on interest payments which gets added back. Additionally, the percentage of this equity in the overall capital composition is accounted for. This is multiplied by the expected rate of return expected by the shareholders or the cost of the equity. Summing up the debt and equity portion yields the weighted average cost of capital or WACC, reflecting blended stakeholders and shareholders' expectation, debt servicing cost by capital mix proportion, and also in essence, WACC allows determining consolidated hurdles rates for company investment, accounting for both cost and debit equity by appropriate capital structure weights. Let's examine a key concept in inventory management. What is consignment stock? Consignment inventory refers to goods that are in possession of the customer and consuming party whose ownership still rests with the supplying party until the point of actual consumption or sale. Here are the vendor ships release these goods to the buyers who holds in the warehouse on behalf of the sellers. But purchase accounting and payments triggers only after those items get used to sold to an end consumer, ensuring velocity based working capital leads. This way, the risk of unsold finished goods and inactive spares exposures sits with the consignors rather than the customers. Root of the stocks counts reconcile actual consignment withdrawal, triggering resupply from the vendors. In essence, consignment inventory allows just in time placement with payment on consumption rather than upfront procurement, thereby preventing excess stock build up for certain products or industries. So that explains the logic behind consignment stocks from ownership and financial management standpoints. Let's examine the two common shipping terms. What are blind shipment and bread bulk cargo? A blind shipment refers to dispatch arrangement where the source identity of a supplying vendor or manufacturer is intentionally kept hidden from the buying customer during the transit. This allows anonymity around supply source as needed. In the other hand, the bread bulk refers to export shipment where the containers consist of multiple small packages unit like crates, cartons, barrels and pallets rather than one large packaged item. This common for goods with high handling and shipping values. So in summary, the blind shipment protects suppliers' identity in transit through anonymous dispatch paperwork, while the bread bulk denotes consolidated containerized cargo consisting of smaller packages SKUs for export distribution efficiency. This explains the difference between the two commonly used terminologies in global shipping. Let's analyze the common dilemma. Is debt financing cheaper than the equity from the cost perspective? Generally, debt works cheaper than equity due to the following reasons. Number one, debt gets paid out before equity in case of business liquidation due to higher ranking creditors' rights, and this lower risk translates to lower required items. The debt often carries collateral in assets and has been defined maturity, giving the reclaim flexibility, driving lower cost. The interest cost of debt is also tax deductible, providing value saving passed on the lenders, allowing the lower debt yield. In contrast, the dividend of equity do not enjoy the preferential tax treatment, leading to higher costs. The pecking orders during the terminal payouts also ranks the debt above equity claims, leaving shareholders the residual claimants. In summary, the preferential rights define maturity and tax shields enables debt to typically emerge as a cheaper financing avenue over equity through blended WACC model and argue for optimal mix balancing both for stability.